Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your July 2020 market update. Well, for the month of July, we saw a continued rebound in many asset classes. Year to date, we are now marginally positive on the S&P 500 index, which is a measure of the performance of the largest stocks in the United States. Other parts of the equity market, such as small cap, international developed, and emerging market stocks, had a positive month as well, but remained negative year to date. And on the bond side, domestic investment grade bonds, which is represented by the light blue bar there, continue to provide investors with returns as yields hover near all-time lows, and the Federal Reserve continues to backstop many parts of the bond market. More risky areas of the fixed income market, such as high yield bonds and emerging market bonds, which are the two bars on the far right-hand side of this chart, continue to recover as well. And overall, we've had one of the best rebounds in history over a very short period of time, but this is juxtaposed against an economy that doesn't appear to be incredibly healthy. On Thursday, the Commerce Department reported that the COVID pandemic triggered the sharpest economic contraction in modern American history. As shown here, the shaded bars indicate recessions since 1947. And as you can see, gross domestic product, which is the broadest measure of economic activity in the United States, shrank at an annual pace of 32.9% in the second quarter, as numerous states shut down in an effort to slow the spread of the virus, which has killed more than 150,000 people in the United States. The economic shock in April, May, and June was more than 3 times as sharp as a previous record of 10% in 1958, and nearly 4 times the worst quarter that we experienced during the Great Recession of 2008-2009. So certainly a very sharp contraction in GDP, but it is about what we expected to come in given the widespread shutdowns that we experienced. So while the drop in GDP was mostly due to a decline in consumer spending, the economic fallout was cushioned somewhat by an unprecedented level of federal relief, which is shown on the left-hand side of this slide. And those government payments help prevent an even steeper drop in consumer spending, which is the lifeblood of the U.S. economy. And this in turn provided a floor for the markets. So while we've had a very, very steep contraction in gross domestic product, because the government and the Federal Reserve stepped in to backstop some of the issues going on with the economy, that really helped prop up the markets and helped lead us to one of those sharpest recoveries in history. And Congress is currently working on additional stimulus measures now as well that should provide further support for the markets. On the unemployment front, in June, the unemployment rate was 11.1%, which, as you can see by the gray line on this chart, is higher than during any previous post-war recession. And historically, it takes years for unemployment to return to pre-crisis levels. You can see different high points there shown by the dots during past recessions. You can see it usually takes a pretty long period of time to recover jobs lost. In the most recent recession of 2008-2009, it took almost 6 years for unemployment to recover. And what we've been hoping for over the last few months is that the large rise in unemployment that we've seen during this COVID-19 pandemic shock is that most of the unemployment would be temporary, given that it is related to health shock. However, many temporary claims are increasingly at risk of becoming permanent job losses as businesses close for the second time or become insolvent. So we are certainly watching this closely. And this is the backdrop that we have heading into a presidential election. COVID-19 and the resulting economic hardships, as well as heightened racial tensions, has dampened Trump's probability of being reelected. And this has caused many investors and many of our clients to ask the question of, what are the implications of possible election outcomes on the equity market? So I wanted to address that today. Well, uncertainty heading into an election does tend to be a headwind for stocks. The market normally corrects and then consolidates in more of a choppy fashion when you're in the primary season. And as shown on this chart of the S&P 500 index, market returns are typically lower during an election year. So typically returns are 5.8% for the S&P 500 versus 9.6% in a non-election year. and volatility is higher, as you can see in the right-hand side of this chart. In an election year, volatility tends to be 15.8% versus 15.2% in a non-election year. However, and this is a big however, this is significantly skewed by major recessions and market events during recent election years, such as the bursting of the tech bubble in 2000, as well as the global financial crisis in 2008. So we did have some large market events that did influence those numbers that I'm showing here. If you look at market data over time, as it relates to, which party takes Congress and the office of president, what we found is that an incumbent president has won re-election 65% of the time since the Civil War. However, in all instances in which the incumbent lost, there was a recession or a depression during their term. So given that data, the track record currently doesn't bode well for President Trump, although quite a bit can change over the next few months as we approach November. One of the things that we've been looking at a lot is how the presidential election could impact different sectors of the economy or the economy as a whole. And one thing to point out here is that the U.S. presidential candidates present two of the most divergent political approaches in recent memory. There are policy differences between Biden and Trump on how to address things such as the role of government in healthcare, the COVID-19 crisis, tax system, immigration and the workforce, climate change, and how to address foreign policy. And given that we haven't had the typical presidential election campaign this year because of COVID, many of Biden's policies are still very unclear at this juncture. So over the next several months, we hope to gain much more clarity on Biden's policy platform. So from what we know so far, the biggest change that we foresee if there were to be a Democratic sweep, meaning in Congress and in the office of president in November, is taxation. So Biden has proposed raising the corporate tax rate from 21 to 28%, which would unwind much of the benefit from the Trump tax cuts a few years ago. But the impact on corporate earnings could also be offset by additional measures of fiscal stimulus in the form of direct payments or in infrastructure spending, which is a big part of his policy agenda going forward. We also believe that we would likely see increases in personal capital gains taxes and additional regulations in terms of the environment and on different businesses. But on balance, we don't expect the November election to have a material impact on equity markets at this juncture, given what we know so far in terms of what agenda he would be taking into the office of president. And so the other reason why we don't expect to have a material impact is because Biden is more of a moderate candidate. However, regardless of what happens, there are certainly sectors or asset classes, such as municipal bonds, that may become more attractive if there is a Democratic sweep. And as such, we'll continue to assess the market environment and make decisions to the portfolios as warranted. We thank you for your continued confidence, and please reach out to us with any questions that you may have.